Good afternoon, everyone, and welcome to today's webcast. Back to the basics with defined outcome ETFs. My name is Graham Day. I'm with Innovator ETFs. Wanted to thank you all for taking time to join us today as we dive back into a better understanding at a high level of what defined outcome ETFs are. A few housekeeping items before we start the webcast. There will be a replay available. Slides are also available to be distributed. So please let us know if you'd like to receive a hard copy of the sleeves. And actually, you can download the webcast slides as part of the webcast interface. So if you have any questions on that, please let us know. There's also a section to submit questions on this webcast. So please submit as many questions as you're able to. We will get to as many as possible. We're looking to keep this webcast to around 45 minutes, but any questions that we are unable to get to, we will be sure to follow up directly with you shortly after the webcast. Today, I am joined by Wes Matthews, a Director of Portfolio Solutions at Milman FRM. Milman is the sub-advisor behind the defined outcome ETFs and a key partner of ours. And later on, I'll let Wes give a little more in-depth background on who Milman is and really how their expertise in this space is so vital to ensuring that we're able to provide the best experience in defined outcome ETFs as possible. Today, we want to recap where these products came from. What are they? How do they work? How are we seeing these ETFs solve real world problems for financial advisors? So if we go to the next slide, a brief background on who Innovator is. Innovator was founded in 2017. We have a legacy of innovation within the space. Our pedigree stems back to PowerShares ETFs. And for those that aren't familiar with PowerShares was acquired by Invesco in 2006, but continues to be one of the leading brands for ETFs. And our two founders that were the founders at PowerShares had stepped away from the business. And important story as to why they got back in is really a story that leads us to the defined outcome ETF lineup. At some point, one of our founders ultimately was sold and purchased a insurance policy that had embedded downside protection and an upside participation, but it wasn't an insurance wrapper. And as many advisors are very familiar with, the insurance wrappers are often suboptimal in terms of liquidity, fees, commissions, and the experience wasn't great. But it really got him thinking. The ETF space has been sliced and diced in so many ways. How is it that no one has brought an ETF that offers investors upside participation to a cap, but also with a known downside buffer level? If we could do something like that, that would be something that would solve a lot of problems that advisors have, not only with the existing structures available to advisors, but it would also be the first ETF that offered a built-in buffer. There are many strategies out there that seek to mitigate downside, but the level to which they're able to mitigate is largely unknown. Really at Innovator too, we wanted to innovate. We wanted to be something or a firm that's known for bringing products that are not available anywhere else in the market to really drive innovation in this space with regards to defined outcome investing. When we look at smart beta or market cap weighted indices and ETFs, that space for the most part, we believe, has largely been sliced and diced to a point where it's very challenging to really add any value to the end client. But we think with these buffered ETFs, that we are providing something that's new, it's unique, and it's value add to financial advisors today. When we look at the demographic of the investing community today, what we found is that the vast majority of investable assets today sit with investors that are either in retirement or approaching retirement. 75% of all the assets. And those investors are, for the most part, no longer looking to take on full market risk. They're content with 6 or 7% of growth per year. If they miss out on a 20 or 30% up market, they're okay with that. What they're trying to avoid or hedge against is the possibility of another 2008. They want to stay invested, but with a built-in buffer. And it's a reason why the space of annuities and structured notes is so large, because to get that type of payoff previous to the defined outcome ETFs, an investor would only have the option to go to an insurance company or a bank to offer or receive a payoff that had a known downside buffer built in. But as I mentioned earlier, there are a lot of problems or issues that advisors have had using those wrappers in their books. And so if there were a way to provide easy access, a more cost-effective strategy, tax-efficient solution in an ETF wrapper, we thought that that was a compelling value add proposition. Not only from the point of a perspective of a retiree, but also just broadly thinking at about the investment community as a whole. When you look at a 60-40 over the last 20, 30 years, investors have, for the large part, they have benefited from both a rising bull market in equities, but especially in bonds. And because of this, we don't think that a 60-40 is going to have the same type of performance over the next 10, 15 years as it has over the last 20 or 30 years mathematically, unless interest rates go negative or go to zero, which the Fed has strongly really signaled that they're not going to go to those levels. It's just not going to be possible mathematically for bonds to deliver that type of performance that they historically have. And because of that, because of the potential for heightened correction risk within equities, we believe that a lot of advisors are currently rethinking, how do I allocate my clients so that I have upside participation, but I also have a known and quantifiable downside buffer. We think that the defined outcome ETFs are a solution that makes a lot of sense. And even going back to the previous slide, these ETFs solve a lot of the challenges that we think advisors are facing today. Clients are, but maybe have been hoarding cash for a long time. They're worried about their bonds. They don't want to just add naked exposure to equities, given where we're at from a valuation standpoint. They don't want to be buying at the top. And so what we found is the concept of defined outcome in investing in these ETFs allow investors to just stay invested, but also know that they have a built-in buffer in place. Really, again, solving problems that we know a lot of advisors are having with their clients today. So why don't we dive into what are these products and what is defined outcome investing? And so with that, I'm going to turn it over to Wes.
Thanks, Graham, and good afternoon, everyone, or morning, depending on where you're calling in from. As Graham mentioned, I'm with Milman, and for those of you who are not familiar with Milman, we're a good-sized actuarial consulting firm. that does a lot of work in the insurance space. And my division in particular is financial risk management. And we focus on delivering risk management solutions for all different asset classes. A lot of our work historically has been in the insurance space. We manage risk overlays for about 150 billion that are tied to investable products in the insurance space. And more recently, we've had the opportunity to partner with great folks like Innovator and help launch more retail-friendly funds like an ETF wrapper here. So that's really the background of what our firm specializes in, is operational execution of risk management strategies. Along with some of that work, we've done some studies as well about investor behavior and what affects investor behavior. And one of the things we've found is that, and this is intuitive to most people out there, but it's really hard to stay involved through a market cycle when an investor experiences significant downturns. And that's where defined outcome investing as a concept really lends a lot of value. On the slides here, we're showing you that there's a lot of different things that we can kind of pick out ahead of time and make known that typically are not known with investing. We're seeing a lot of people currently sitting in cash or over allocated to fixed income because of the historic protection that's offered. But with defined outcome investing, we let investors or advisors dial that in and say, in this case, pick an index that you're interested in. How long would you like to have exposure to that with the parameters we're offering? How large of a buffer? And then what type of upside cap do I get in exchange for that? And how often does this fund rebalance? So those are the questions that an investor advisor would have to ask themselves or their clients in terms of figuring out a solution that best gets them comfortable with their current investment strategy. So if you go forward one slide, we can see how that plays out with these funds. So taking the S&P 500, for example, that is one of our reference asset classes that we offer. We have 1 year period outcomes for the funds at this point. And then we have 3 different buffer levels that are available for investors. We have a 9% buffer, a 15% buffer, and a 30. The caps, as we mentioned, are variable, but there are a number of tools, which Graham will cover quite a bit later, that give you an idea exactly where your cap is on any given day, or even look historically to see where they have been. And then the rebalance, this is one of the questions we actually received ahead of time for today's webinar was, what happens at the end of that 1 year outcome period? And we will have a rebalance that occurs where the options are rolled into a new basket. And I'll cover that again in a few minutes here. But the benefit of defined outcome investing is clear, and the ETF wrapper itself makes that even more attractive by offering liquidity, transparency, easy tradability to get in and out of the markets, tax efficiency with the ETF wrapper, a low cost, as well as limiting credit risk like you'd get with most issuers out there. One question people often ask on the next slide is, what does the next year look like depending on which product I buy? Obviously, buying one product over another depends strongly on what your personal opinion is of where markets are headed. But if we look at 4 kind of typical examples here, let's say the benchmark index is the yellow. If there's a major market decline in the next year, how do my 3 different types of products hold up? So the buffer product is 9% buffer. So, and Graham will go through the nomenclature later, but a buffer product is a 9% buffer, the power is the 15, and the ultra is the 30. So let's say the market is down 30%. The buffer would be down 21 because you have 9% of that buffer. The power would be down 15 because you have a 15% buffer versus the 30. And then the ultra would be down 5. And that's because while you have a 30% buffer, it's from -5 to -35. So you'd experience a small loss, but significant outperformance. For a market dip, let's say the market's down 10, the buffer would be down 1, the power would be flat, and the ultra would be down 5. I should also mention these are gross, obviously, so you would have some small negative because of the fund expenses. Growth market, if the market's up 8, all 3 of those funds, given where caps are at today, would experience the full upside potential over that 1 year period. And then in the very high growth market, 20% up based on current caps, we'd see a 14% upside cap with a 9 on the 15 buffer, and an 8 upside cap on the 30 buffer product. So the following page shows you what different exposures are available. Like I mentioned, there's the 9 buffer, the 15, and the 30. We have the S&P exposure available in all 3 buffers, but we also offer international exposure for the MSCI EFA, as well as emerging markets and Russell 2000 for small cap, and then NASDAQ for more of a tech exposure. And those are available in a 15 buffer at this point. So with that, I'll hand it back to Graham to kind of talk through the partnership a little bit more.
Great, thanks a lot, Wes. And one thing to just add on to this current slide is, at Innovator, we want to be able to provide investors exposure to global equity markets with built-in buffers. And so whether an advisor is wary of US equities or wants to dial risk down in the US or internationally, they're looking maybe to dip their toe into emerging markets, but don't want to stomach the increased volatility levels of an unhedged exposure. Having a variety of various equity indices underlying these defined outcome ETFs, we hope allows an advisor to more precisely implement these ETFs and make them more relevant to an advisor's practice. But if we go on to the next section, so how exactly do these ETFs work? It's one of the most common questions we get, given these are unique. This isn't an equity underlying ETF. These ETFs use options, but one thing that we just want to make clear is, even though these ETFs use options, we've been part of building and distributing a number of ETFs over the years. These ETFs are actually at the heart very, very simple. A very simple portfolio of 7 options that don't change during the outcome period. Really straightforward, and something that Wes will touch on in just a moment. But when we look at who's behind these ETFs, we talked a little bit about Innovator. We talked a little bit about Milman, but really just want to emphasize the expertise that Milman, as our sub-advisor, brings to the table. They've been doing this for a very long time. And when it comes to trading and managing options-based strategies, there definitely is a level of specialization where having someone with the pedigree, the size of Milman behind these ETFs, we think is a huge benefit to us. We partner with some of the largest exchanges in the world, the largest and most well-known index providers, where at the end of the day, like I said before, we want to provide buffered exposure to the largest and most relevant asset classes to advisors today, and hopefully this slide demonstrates that. So I'm going to turn it back over to Wes, and Wes, if you can just go through and at a high level share with our audience, how exactly are these ETFs constructed?
Sure, no, happy to. So we get these questions a lot, is how are we possibly able to deliver the stated outcomes and desired exposure that we say? And as you can see on the slide here, we can break that up into 3 different pieces. So using options, and I should mention we are using flex options. Flex options are exchange traded options that go through the CBOE exchange and are backed by the OCC, that basically allow you to customize your maturity dates and strike prices. So they're still exchange traded options just like every other option out there, but we're able to customize them to the exact outcomes that we want. So in this case, layer 1, we use 4 different options to create long exposure to the coordinated index. So in this case, the 500. So we're able to give you exposure to the 500 through the use of options as layer 1. Layer 2 is the purchase of what's called a put spread. So it's 2 different options that give you that downside buffer of 9, 15, or 30%, which is a cost to the fund. Now, in exchange for that, we have to sell an upside limit, and that's layer 3. So layer 3 is an upside cap, which is a single call option that helps pay for that downside protection that we just purchased in layer 2. So the 3 of those combined give you 1-to-1 exposure of the S&P up to a cap in exchange for a downside buffer. And if you go to the next page, one of the questions we get frequently is, okay, so what happens after day 1? What if I want to bring money to the table a couple months into the strategy? What does that look like in terms of how we all would go out and buy options? Is there a new basket of options or not? And the answer to that is no. is that we are always using the same basket of 7 options. So if you look at number 1 there, it's showing you that at inception of the fund, or on the roll date, we'll call it, we establish a basket of 7 option positions. And for argument's sake, we're just calling them A through G here. If you fast forward a few months to step 2, or level 2, that could be somebody bringing new money to the table with a large influx of cash. And we have this happen on a daily basis. What happens is behind the scenes, we go out and we'll buy the exact same basket of options we bought on day 1, but they'll have a different value. Just like any stock or anything you buy out there in the marketplace, if your friend buys it day 1 and you buy it later, you'll have a different upside compared to them by the end of the year, but you're still buying the same underlying. We're doing the same thing with options, is that we buy the same basket of options, but it's just costing us a different price at that point in time, which is going to be reflected in a different cap for that investor. At step 3 is the end of the 1-year outcome period. Those options will all be expiring, and our team will immediately flip those into a new basket of 7 options for the next 1-year period, thereby delivering you a new buffer, the stated buffer of either 15, 9, or 30, and then a new cap, which we will know at that point in time what that is. So during the 1-year period, it's always the same basket of options until you hit the new reset, which is on an annual basis.
Yeah, and Wes, just to jump in real quick here, this is one of the questions that we get is, if I'm buying at point 2, can I still achieve a defined outcome? And the resounding answer is yes. That, like Wes was saying, you're simply paying a different price for the same basket of options, but you can still achieve a defined outcome. In this pop-up here, and we'll talk a little bit more about the web tool that's available on Innovator site that we developed, shows exactly how much upside you have remaining, how much downside buffer you have remaining, and how much time is left in your outcome period. And that's just something that's, I think, is very valuable for advisors to understand, is that regardless of when you buy these ETFs, at any point during the outcome period, you can still achieve a defined outcome. What will have changed are just, as Wes mentioned, the prices of the options. And if I can go back just one slide to the other question that we often get is, okay, so 7 options positions, can you just put it in context of how I can share this with my client? How exactly is this working? And so to really add on to what Wes was saying, if you think about layer 1 is your S&P 500 exposure, and with that, you actually get the implied dividend of the S&P 500, of a financing rate up front. That's, we'll say, 2% or $2. With that $2, you're going to go out and you're going to buy layer 2, your downside buffers of either 9, 15, or 30%. But let's say that those buffers cost you $4. So you got $2 from the dividend, but you're outlaying $4 for that downside buffer. So you need to come up with $2. And so that's where layer 3 comes in, where we will sell a call that will generate that $2 of income to make it a zero cost options strategy. And so really that's it. That's at the end of the day, it's a very simple strategy. So Wes, I'll turn it back over to you.
Sure. Yeah. So if we go to slide 16, one question again that commonly comes up is, well, how does this thing actually perform and hold up over a 1-year period? Can you show me that you've actually done what you said you're going to deliver? And thankfully, we've had 3 different series now that have completed a 1-year outcome period. This is one of them here. This is the Power series, so the 15% buffer of the January. This one recently expired a little over a month ago. Not expired, I should say, rolled into its new bucket of options. And as you can see, it performed very well over time, similar to the S&P, while lagging slightly behind. Now that lag behind, as you can see in the dark line, is because they have a cap that it's approaching, and that cap was stated at 13.9%. And you can see the S&P hit that fairly quickly, actually, in the first 4 or 5 months of the outcome period. And the fund, PJN fund, was able to appreciate and participate in a good portion of that. Now, it wasn't until the end of the outcome period that you actually realized the full potential, because the S&P finished above that line, and there's always time value that remains in options. So forget the 7-option basket and the complication that may seem to present. If you just bought a single call option on S&P exposure and the market moved up, you would not move up 1-to-1 every day with the underlying exposure. There's time value in any options. So in our basket here, we have a 1-year time period. So every day this thing moves along, it's going to have some time value remaining, which will keep you from being 100% where the underlying exposure is at. However, at the end of the outcome period, you will fully realize the underlying exposure up to a cap or minus the buffer if the market had been down. So if we go one page further, we'll see the actual numerical breakdown of performance. So on the first line, you have BJAN, which is our 9% buffer product. It had a return of 21.4 compared to the S&P 500 index of 28.9%. However, you achieve that with significantly less volatility and lower drawdowns over that time period. And if you look at the far right, it had a stated outcome cap of 22.3. The difference there is reflective of the fact that there are fund fees of this fund, and those are your expense ratios. If you look at the middle lines there, that's your power series that we just looked at on the previous slide. And that realized a return of 13.1 versus that same 28.9 for the S&P. And your vol was less than half in this case, with a really tiny max drawdown over that same outcome period. And then in the last couple lines, you can see what the Ultra series would have done. It would have been 11.1% return with, again, extremely low volatility over that same time period. And I think what's interesting to point out here is we were performing exactly as stated, minus our expense ratios over the time period, over the full outcome of that 1-year period. What's also interesting is to look at how the 3 different types of funds performed relative to each other. Typically, we do see the caps being higher on the buffer series, and that's because you have a less of a downside buffer built into that strategy, which enables us to sell a higher cap on the upside typically. And so you will typically see caps be higher on the buffer series, and if the market does rise like it did this last year, those will outperform the other 2. And now, obviously, the inverse would be true if the market really fell apart and dropped 30-40%. You would see that Ultra series that has the 30 buffer outperform on the downside. So that's the benefit of having multiple different options out there in terms of a 9, 15, or 30 buffer, is that depending on what your view of the market is or how concerned you are about rising or falling markets, we have different options available for you to invest in. Graham, I think it's back to you on how people can use these in a little bit more detail.
Yeah, and actually, if we go back one slide, to the point that Wes was making earlier, that someone can achieve a defined outcome at any point during the outcome period. Another question that we get is, okay, but what if there's a lot of buying and selling during the outcome period? Well, the 3 series that we've had successfully completed outcome periods on, all of them experience significant inflows and outflows during the outcome period. And so there is no impact to existing shareholders who are maybe bought earlier. And if people are coming in and out of the strategy, that has no impact on the existing shareholders' ability to realize the defined outcome. And so just another question that we typically get, but that speaks to the liquidity of the underlying, the efficiency of index options, the option space in general, but something that we wanted to point out to you all. So in this next section, what we want to cover is we want to talk about how do these ETFs work from a perspective of the advisor in implementation, understanding how these ETFs work in your portfolio. And so to start at a really high level, Wes touched on this, but when we were thinking about the ticker convention, how we wanted to make sure that an advisor could simply look at the ticker and know exactly which ETF he was owning. So the example here that we use in this slide is, if you think about your S&P 500 or our S&P 500 defined outcome ETFs, if you pick your buffer level, let's say you pick the 9% buffer level, that's going to be a B as in buffer. And then you pick the month, let's just say JAN. Well, you put that together, BJAN, and you know exactly that you own the Innovator S&P 500 Buffer ETF. If you had picked a U and then JAN, you would have known that you owned the Ultra series, the 30% buffer series that with the January month. And so hopefully this is something that allows you to understand exactly what you own simply by looking at the ticker, not only for the S&P 500s, but for the emerging markets, for example, we use E for emerging markets. And so if you owned EJAN, you would know that you own the emerging markets 15% January series ETF. So something that we found very helpful for advisors to just understand and organize exactly which of the defined outcome ETFs that they own. But we showed on the next slide really at the one of the most beneficial tools that we've seen advisors use is the Innovator pricing tool. This is a proprietary tool that we developed a few years ago, and really it was in conjunction with the SEC. And the SEC had said to us, these defined outcome ETFs sound really interesting, but what if someone is buying after the beginning of the outcome period? How can they understand what the parameters are going to look like? And so we built this tool so that an advisor can come to the website and know at any point during the outcome period exactly how much upside he or she has remaining, what downside before the buffer they have, what downside buffer they have remaining, and how much time is left in the outcome period. If you haven't had a chance to take a look at this tool, we would highly encourage you to look at it, as it is the most effective and most powerful tool that we've seen advisors use to better understand how these ETFs price in the secondary market, how they're going to move with the reference asset throughout the outcome period. And we're happy to answer any questions that you have. Our advisor consultants go through this tool with advisors multiple times throughout every single day. And so if you have any questions on better understanding how this works, please let us know. So when you come to the web tool, here's kind of a snapshot of what you'll see. And so we just want to spend a minute going through exactly what each of these data points mean. So working from the top down on the right hand side, that 1.37% represents the price appreciation of, in this case, PJAN since the beginning of the outcome period. The 7.04% is how much upside is remaining in this ETF up to its cap over the remainder of the outcome period. The 15.54% is now the amount of downside buffer that PJN has over the remainder of the outcome period. The 1.35%, the negative 1.35%, represents how much an advisor could lose before his buffer is going to kick in. And that's simply that 1.35%, it represents the price appreciation of PJAN since the beginning of the outcome period. But I want to draw your attention moving to that last data point, 2.27. That's the price appreciation of the S&P 500 since the beginning of the outcome period. Now, in order for an investor to lose that downside before buffer, that 1.35%, that would require the S&P 500 to fall back to zero. So the S&P would have to fall approximately 2.27% for that investor in PJN to lose that 1.35%. And then finally, that second to last data point represents how many days are left in the outcome period. So in this case, there's 331 days left in the outcome period. And as Wes described earlier, at the end of the outcome period, the ETF will simply rebalance into a new portfolio of options. The outcome period will be reset to 365 days, and you'll get a fresh upside cap and a fresh downside buffer. So if you have questions on this web tool, please let us know. So where does it fit in my portfolio? How are other advisors, or how can I use these ETFs in my portfolio? And I think this slide is just a powerful illustration that we like to share with advisors who in turn, I think, put this in front of their clients, because these ETFs are very practical. And if someone has an express opinion on what they expect the S&P 500 to do over the next 12 months, these ETFs are very effective in addressing kind of those market expressions. If an advisor or their client were to think that the S&P were to maybe go up 15% or be down 15% over the next 12 months, we think that that is the sweet spot for the 9% and 15% buffer ETFs that we offer. Why? Because if you pick one of those ETFs, you're really going to be right regardless if the market goes up or if it goes down that 15%. If we use a cap of 14%, if the market goes up 15%, you'll be capped at 14%. But you did so, you were capped knowing that if the market were down, say 10%, you would only lose 1%. Given how far we've come in this equity bull market, there are a lot of advisors, a lot of investors who understand that the likelihood of high double-digit gains going forward is not very likely, and it's more prudent at this point to be more defensive, so that when the market does have an equity correction, you will have realized your buffer and then be in a position to be able to rotate perhaps back into an unhedged exposure. If you have very bearish clients, if you've got clients that are worried about another 2008, well, that's where our ultra buffer can make a lot of sense. If the market were down 28 or 38% as it was in 2008, you know that you've got a 30% buffer. And so in that instance, you would just be down 8% while the market was down 30%. If we go to the next slide, how or where are people and advisors using these ETFs within their portfolios? Really, the first is probably their equity buckets. As I mentioned before, it's just a simple way to de-risk the equity sleeve of their bucket right now. For those retiree clients, we're finding that a lot of advisors are using this as a core equity position. Why? Because those clients no longer require unhedged upside equity upside returns to meet their goals on a go-forward basis. And so these ETFs provide the necessary upside potential, but really mitigate those scenarios that the retirees don't want to experience, and those are the large drawdowns. But also, from a simple valuation perspective, even those clients that are maybe a little more aggressive in terms of their risk profiles, a lot of them are simply using these ETFs as a way to just take their foot off the pedal, remain invested, but have a built-in buffer, again, so that when the market does correct, they'll be in a position to go to their clients and say, look, we buffered some of the downside, and now we can afford to take a little more risk, as opposed to being in the position where you're down as much as the market and going to your client after the market's down 30% and you're down 30%. It's a very challenging prospect to tell them that now is the time to take more risk. We're seeing this used also as a fixed income replacement. A lot of people are simply using fixed income as a way to hedge their equity positions. They're hoping that when the market goes down 20 or 30%, their fixed income sleeve will provide a buffer, if you will have positive price performance in that environment. The problem is, with yields where they're at now, with the stance the Fed has taken, mathematically, the downside buffer that bonds can provide is nowhere near what it provided back in 2008. And so whether as a high yield bond replacement, as a way to mitigate rate risk. If equities go down and bonds and rates go up, bonds are going to go down. And so this is a way for people to add a known and quantifiable built-in buffer to their portfolios. As I mentioned before, really a lot of this whole concept was born out of trying to provide a more efficient, effective, better wrapper for advisors to access these payoffs. We're seeing these used as an alternative to indexed annuities or to a certain extent structured notes. For those that want to be able to put these across all of their client accounts, the ETF structure is very efficient in doing so. Wes pointed out a number of the benefits, the lower cost. We tend to offer higher upside caps because we have lower fees. There's no commissions. There are no surrender charges for getting in or out of these products. And there's no credit risk. And that's something that credit risk matters or doesn't matter until it does. And so for those clients that are wary or experienced a Lehman or bear situation, these ETFs take that credit risk off the table. And then finally, as a cash alternative, if clients have too much money on the sidelines, these ETFs can serve as a cash alternative. And as we go to the next slide, I'll just pass it over to Wes.
Yeah, I was going to jump in there and say we can provide you guys with a couple examples. So as Graham mentioned, there's actually quite a few different ways we've seen people using these funds in their portfolios. And I wanted to touch on a couple here that are kind of simplified, but based on recent conversations we've had with a conservative as well as moderate investor. So on the screen here, we have a typical portfolio for a very conservative investor, 40% stock allocation, 50% bonds, with a small sliver to alternatives as well. Now, obviously, this is a very simplified version of some recent discussions we've had with folks, but what they were doing in their portfolios was actually taking away assets from stock portfolios. So 40% here we lowered to 30, and the bond side we lowered by 20% and put that 30% into defined outcome ETFs. And what's interesting about that is that overall, your equity allocation actually is increasing, which is counterintuitive to what you'd think an ultra-conservative investor would do. But it's because you have the buffers built in that you're able to increase your equity allocation and feel good about it in these markets. On the flip side, conservative investors have historically relied on bonds for protection or yield, but we are at the end of a 30-year secular bull run here. And so with the rates having come down almost as far as they can possibly go, most people are looking forward 5 or 10 years and seeing some risk in the fixed income space that wasn't there for the last 30 years. And this is a way to deallocate from the bond side of the things and get back into a defined outcome ETF, which offers long-term, very conservative blended performance metrics. And what I mean by that is if you look at defined outcome ETFs over time, or the index performance over time, it performs very similarly to a 40-60 or 30-70 portfolio. And that's based on comparisons to the last 30 years when bonds had a very good run. So if you'd like to have a similar type performance going forward, this is a way to accomplish that without the current market risk that the fixed income space and equity space, being the longest bull market for equities, exhibit at this point in time. So if you go forward one slide, we have a moderate portfolio, which is more in line with what people expect from either a 60-40, 70-30. In this case, it's a 70, 25, and 5 for stocks, bonds, and alts. And we did a similar thing with the client here, where they lowered their bond allocation and equity allocations by 10% each, which ended up increasing their overall equity exposure to the markets. But 20% of that is now buffered with built-in buffers and known outcome ranges for the next year. Going back to earlier discussions about behavioral finance, this is a big way to help investors, clients, or yourselves even stay invested in the markets and just feel much more comfortable knowing what is my outcome range. That unknown element of investing is what makes people often do the wrong thing. But when the market's down X and you're down X minus the buffer, you knew that ahead of time was going to be your outcome range, and it helps you stay invested for the longer term. Graham, do you want to touch on some of the conversations comparing us to banks and insurance?
Yeah, thanks, Wes. So this next slide touches on a lot of the things that we've talked about, the benefits of the ETF wrapper over existing wrappers. But just want to emphasize the value add that we found a lot of advisors have been able to provide their clients using these ETFs as an alternative to, say, an indexed annuity. We'll hit at this on the next slide, but we've talked with advisors that have bought an indexed annuity for their client. However, as the market has run up, they'd love to be able to realize some of those gains and maybe reset the downside buffer. But in those wrappers, it's impossible to do that unless you are willing to take a 6 to 10% surrender charge. Well, that just doesn't make any sense. And so to be able to use these ETFs, even potentially rotate for those that are a little more experienced with these ETFs, we feel like there's a lot of value add that can be provided to the client relative or over the existing structures, in addition to these benefits that are listed here in the table. But for ETF users too, prior to these ETFs, there really hasn't been any fund that has offered investors upside to a cap on an index, but with a known downside buffer. And so for those that are maybe using low vol, but are concerned about interest rate headwind on the low vol strategy, now may be the time to take some of that exposure off the table and rotate into the defined outcome ETFs, where you know exactly how much buffer you have should equities correct. The amount of buffer that low volatility may provide in the future is largely unknown. We can look historically as to what it's provided, but again, that's just what's happened in the past. These ETFs allow you to look forward and know what your upside is, as well as how much downside you have. And another thing that we want to point out too is that a huge benefit of these ETFs is that that they are now tax efficient. And so we've gotten a number of questions about, are these ETFs tax efficient? Why are you using index-based options? And the benefit of the ETF wrapper, just like any other ETF, is that through the creation redemption mechanism, we are able to keep high cost basis positions in the fund and redeem out low cost basis positions that have embedded gains, which results in a tax efficient ETF. And so we think that's a huge development for advisors. So these ETFs will be as tax efficient as any other ETF. And so it doesn't matter if you use index-based options or fund-based options. We know there's been a lot of commentary out there that's potentially said that these ETFs may not be tax efficient, but we're happy to demonstrate, and we have demonstrated in a number of cases, that these ETFs are tax efficient. And going forward, we do not expect any sort of capital gains distributions. And so that tax efficiency point, we think, is a huge win, and so another value add that these ETFs provide relative to existing wrappers. And if we go to the next slide, this touches on an idea that is actually brought up in a few questions that we have listed here is, well, if the market's going up, do I just want to buy and hold that existing series that I'm in? And this is one of the benefits of the ETF wrapper, and a way that we've seen advisors add value for their clients. In this example here, this is simply showing that as the market went up in 2019, that you were able to, throughout the year, rotate from, say, the January series into the April series. You were able to reset your buffer at a higher cost basis, expand your upside cap, and from April to August, again, the market continued to move a little higher. You were able to realize that appreciation by rotating from the April series into the August series, as well as slightly expanding your cap, but more importantly, resetting your downside buffer at a higher cost basis, and doing the same thing from August to December. So over this time frame, your starting buffer level was at $100, but by the end, your starting buffer was closer to $122. And so we think that's a huge value add. That means that if your buffer is now at 122, you have a, say, in this case, a 9% buffer on a $122 cost basis as opposed to a $100 cost basis. And you've also expanded your upside cap. So this is one way that we've seen advisors implement these ETFs into their practice. The last thing that we like to touch on with as we introduce these products is just the overall liquidity behind these ETFs. Because traditional structures have tended to be just a little less liquid, where maybe with a structured note, there's less clarity as to what the pricing you can get on a note, that you only have one counterparty to get a price from. Or with an insurance product, there's the lockups, there's surrender charges. Those vehicles overall have tended to just be illiquid or less liquid at best. And these ETFs are very, very liquid. And the reason for that is because an ETF is going to be as liquid as its underlying constituents. In this case, our ETFs hold options on some of the most well-known indices in the entire world. And what does that mean? That means there's a huge breadth and depth of liquidity across all these markets. When you look at how much open interest there is and how much volume there is in SPX options or S&P 500 index options, you can see there's $420 billion traded every single day in this space and over $5 trillion of open interest. So to put that in perspective, what does that mean for someone who's buying or selling our ETFs? That means that if you were to buy $500 million of our ETF today, we with Milman would go out and acquire $500 million of the underlying options. Now, that's a lot of money, but when you put it in the perspective of $400 billion, it's just a drop in the bucket. And so that's one of the benefits of these ETFs is that they are extremely liquid. You can buy or sell these ETFs in small quantities or extremely large quantities. And it's all supported by how liquid the underlying market is. We've seen blocks of over 1 million shares trade regularly on these ETFs and continue to see people rotating between the series in or out. There's a lot of liquidity here. What we do recommend though is if you haven't bought or sold one of these ETFs before, call us. Let us walk through exactly how you can achieve best execution with these ETFs. We're happy to put you in contact with a number of liquidity providers, market makers to ensure that you get the best execution experience possible. So with that, we are going to just go through a few questions in our remaining 5 minutes. So we've gone over a little more than we'd hope, but the first question that we will take is, and Wes, I'm going to pass this one over to you. Do you think that you could build kind of a laddered approach using these ETFs? I think maybe the question might be similar to a bond ladder. What do you think about building a laddered approach with these defined outcome ETFs?
Yeah, if I understand the question correctly, that's definitely something you could do. Now, obviously, the current structures we have out there and available are 1-year outcome periods. That's not to say we might not roll out other outcome periods in the future, which would make laddering a little bit easier as well. But given the current offerings, we have seen people ladder these out. Now, obviously, you can only go a year, but within the 12 offerings we have for each exposure, or each buffer, I should say. We have groups that are aggregating. Some are allocating a few times a year. Some are laddering these across all 12 months as well, whether that's tactically or just based on when flows come in. But again, the question usually comes down to what's the ultimate goal for why you're laddering or allocating the way you are. So like Graham said, in that step-up example, some folks would look at that and say, I'm not interested in realizing short-term gains by rolling out into the newest offering, where others would say, I want to reset that buffer regardless of the fact if I'm realizing taxable gains or not. And so that same decision making would come into mind when you're laddering, given that we have one-year exposures at this point. But I definitely think it's worth looking at, and I think there are groups exploring that as well. I think that'll become probably a little bit more relevant if we bring out longer exposures as well.
Can you touch on, do you have to wait until the end of the outcome period in order to realize the full buffer and the full cap?
It's a good question. The short answer would be yes, you do have to. And that's because, as I alluded to earlier, there's always going to be some remaining time value to the basket of options that we own. And as long as that time value is remaining, you will not fully realize the underlying performance up to the cap or the full realization of your buffer until all that time value is totally out of the option basket. And that doesn't happen until they expire, essentially. And so you will have to wait until the end if you want to achieve the exact stated original outcome period, if you bought in, before day one, basically. Now, you can get very close, and you could be within, 50 basis points or 100 basis points with a month or so left, potentially, if the market's way up or if the market's way down. But yes, you do have to wait till the very end to achieve the exact stated outcome.
Thanks, Wes. One more quick question. And Wes, I think I'm going to pass this one back over to you, but it touches on the buffers in during the middle of the outcome period. And the question is, if you bought a 15% buffer and you're 6 months into the outcome period, if the market's down 15%, how much of that buffer do you think that you're going to have realized?
That's a good question. It's hypothetical, obviously, so I can't give exact numbers. But in general, you said, I think the question was 6 months in. So 6 months in, we're typically seeing a capture ratio of around half, I would say, on average. So if the market's down significantly, typically the funds would be down, depending on how much it's down, about half in general. And that's a hard question to answer because it really depends on the scale of the underlying sell-off. But you will see some participation because options always price in the likelihood that the market can move more in either direction in the future. And so given that there's uncertainty of where markets could continue to fall or rebound, options have remaining value. That's another one of the Greeks when you get into option pricing theory, but that's volatility as well as time value and all the different factors that go into how they're valued. But yes, there will be about, in general, rough estimate, 50% participation in the downside. And was there an exact number in the question, Graham? I can't remember.
It was just if you had the 15% buffer and you were 6 months into the outcome period and the market was down 15%.
Okay, yeah. So the market's down 15%. You have 15 buffer. You are most likely going to be down, 6, 7, 8%, somewhere in that range. And now, to use that example further, let's say nothing happens for the next 6 months and the market stays at 15. You will appreciate and climb back up to the 0 level in your fund's performance.
Awesome, great. Thanks, Wes. And with that, we're just a few minutes over the hour. So appreciate everyone staying on for the entirety of this webcast. There are a number of questions that we unfortunately were not able to get to, but we will get to send these over to our advisor consultants immediately, and you should be hearing from them shortly. Again, a replay of this should be available as well with a slide deck if you would like to receive that. So with that, I want to thank you for joining us today and for your time. We hope you enjoyed the webcast, and we look forward to having a conversation with you shortly. Have a great rest of the day.